You're such an asshole.
Hey everybody, the old captain here, assholeconsulting.com. If you have a question and you have money, then you got me. So you can hire the world's only professional asshole to answer your questions bluntly, directly, and truthfully. And I'm not going to spare your feelings, because feelings cost time, which means it costs money. Where'd the requests go? So I'm much cheaper. As long as I get to curse and abuse my clients. Nick writes, Blue Chip Stock Investing. Dear asshole, I really appreciate Bachelor Pad Economics, The Joy of Decline, the former book I wish I had to read 30-odd years ago when I was in my teens. It would have spared me so much silly teen angst and also many young adult mistakes. The later book helped me cope under the last few years of the Obama administration, which I fear Donald the Maverick, as much of a game changer as he is, will not be able to undo. But more lamenting on that in a later consulting request about trying to achieve potential early retirement. As I am now approaching Generation X middle age, I am looking to try to invest as much as I can so I can retire as early as possible, at least from the daily bureaucrat job that I hate. I have no debt other than the house at 3% in a reasonably nice neighborhood that is appreciating as well, and a car at 1%, which I worked to pay off ASAP, but hey, since I absolutely had to replace my old falling apart jalopy, and if I could finance a new car through my credit union at 1%, what's not like? No, you know what? Those credit unions, that'd be something to watch. The old captain predicts. Watch these car loans where you get this below inflation interest rates, negative real interest rates basically, and then there's like 7 years. I'm like, that the asset's going to depreciate well below the loan balance in about 3 or 4, but no, never mind. I have one stable bureaucratic day job with benefits, a side night and weekend and seasonal gig as a home computer-based CPA, bookkeeper, and tax preparer accountant. Awesome. You're kicking ass, man. I manage my old folks' rental property, and I drive Uber and Lyft whenever I have to be on the road with the new car. Look at, yeah, well, you're a CPA. You know to write that off. So not only do you get an interest rate that's less than inflation, so you're winning on that end, but you're writing off the depreciation as well. That's awesome. Needless to say, I help my old folks with their finances, and I'm looking to earn more money to put away however I can in my spare time. I have a nice pension from the otherwise loathsome day job, and I shovel into a Roth IRA, the max per year, and into the 401k, whatever I can spare. I know you wrote about the commie-crats possibly expropriating these, but for now I see them as investments which I know have a tax advantage. I did buy a stash of silver coinage along with firearms and canned goods for prepping suburbanite life, but silver tanked after I bought it and has yet to recover. Yeah, but you don't think of it as an expense. You're going to expense that. That is not a capital investment. That is it's an insurance policy you buy once and it covers you for the rest of your life. It's a consumer item, all right? So you don't depreciate it. You're not concerned about its asset price. Was it mark to market? You still doing that? What was that? FASB Rule 120 something or other? Oh, I'm glad I got out of banking. Anyway, at the local learning exchange, I met a couple named Eric and Barbara Christensen. They do seminars and sell books about building a financial portfolio on $50 a month. Links are here. And it's booksamerica.com/investing _ MTU4.html. Basically, booksamerica.com, I think that's their website. In a nutshell, their investment strategy goes like this. 1, buy stocks with direct purchase plans, monthly investment plans, and dividend reinvestment plans that avoid brokers. Smart. They say you could do this with as little as $50 a month on average, but the more money, the merrier. Yeah, at those low purchasing rates, it almost is more of a pain in the ass for you to cut the damn check, or it's time. Like, do you remember when you had to pay bills? You're almost as old as me. You're older than me. Remember when you had I got to pay bills. It was an hour fucking process. Now it's all automatic pay. 2, buy long-established blue-chip stocks that pay dividends. The more dividends, the better, and that allow those dividends to be automatically reinvested more into stock. Yeah, DRIP program, dividend reinvestment program. Yep. Repeat until retirement. They avoid risky, aggressive, or unproven stocks, and their argument is that the Procter & Gamble's, the Church & Dwight's, and other dividend-paying, if boring, low-growth stocks will not go bust because no matter how bad things get, people will still buy soap, toilet paper, toothpaste, groceries, and the like. Is that a valid investment strategy? No, it sure isn't. I don't know what he meant right here. No, it sure isn't aggressive growth, get rich quick, but such schemes usually fail, and getting rich slowly but steadily makes sense. Your thoughts? Let me know your fee, and I will pay it and see your YouTube reply email. Okay, well, thank you very much, Nick. And Nick paid extra for this to make sure that I would do it for you guys. I was going to do it for you for what did I charge, 40 or 50? He paid 90. So, guys, thank Nick. He's very friendly. But I did do my research, and I pulled the charts and the graphs. And, well, let me go over that before I go into the details and number. Especially for your particular situation, yes, this is perfect because you have everything else taken care of. Like, you've crossed your I's and dotted your T's, and you're set to go. You maybe pay off your mortgage is the only thing, but I'm extremely conservative. I pay off your mortgage before I'd even consider about investing in 401k or IRA. But if you have all this extra money, and you've bought your silver, and you've done your Roth, you've done your 401k, and now there's really nothing left to invest in but regular old boring stocks and bonds. What is an investment strategy? This is a very good investment strategy. And for all the reasons they highlight there. Now, I went to their site and I read through it, and here's another thing. I trust them because you want to know what they told you? Our guarantees. They are guarantees. You know what they guarantee you? Jack fucking shit. You're a bit more polite about it. They don't guarantee you anything. All they basically say is, look, the historical performance of blue chip stocks obviously has gone up and down. It was the Nifty 50 back in the day. Now it's the Dow Jones Industrial Average, which could be a proxy for it. Some use the Fortune 500. But back in the 73, 74, I remember this. There was like a 20-year period where, well, this is all the stock market, but the Nifty 50 collapsed. Like the advice was in the 50s and the 60s. You can invest in the Nifty 50 and never lose money. And then the 70s came along, you lost money. I think it wasn't until Reagan came into office that it came back. But it was this long period where stocks did not recoup. But that was all the market. But if you look historically, your blue chip stocks tend to recover quicker. They have a lower beta, which means they're less volatile. They're not as, when the stock market goes up by this, it doesn't go up by that much. And when the stock market crashes, it doesn't go down that much. They're more resilient. And their balance sheets are much more stable than these fly-by-night. You obviously remember the 90s and the dot-coms. We haven't made any money. Can you give us more? Okay, here you go, redemptions. So, and as you mentioned, the Procter & Gamble's, your Heinz ketchup, which was bought by Kraft now, I think. If you look at what you buy every day and consume, yeah, those are, quote, your Nifty 50 or your blue chip stocks. So how do you want to measure it, their performance? So I'm going to compare it against the S&P 500. And there's two indices I've used. One is the ticker symbol is Brillix, Brlix, and that invests in it's the Bridgeway Blue Chip 35 Index, so it's kind of like an ETF. They only invest in the creme de la creme, the Nifty 35. There's also the Dow Jones Industrial Average, which you can use. And I compared them against the S&P 500. And it's a very tight band. They do obviously trade very closely to one another. But the Dow Jones Industrial Average and the Brillix both outperform the S&P 500. Not always. There's a couple years where, well, let me kind of eyeball it here. No, they consistently beat the S&P 500. They're always ahead. It got a little tight, 2-3 years ago it got a little tight. But now, the Brillix, your Nifty 35, the blue chips, they're at a 58% rate of return since this goes back as far as the charts will go, like 97. That's how far back this chart goes. The Dow Jones Industrial Average has a 50% rate of return, and then the S&P 500 is at 45. So the Dow Jones and this particular index that claims to track blue chip stocks outperforms the S&P 500 by what? 10? Well, the Dow Jones beats it by 5. And then the blue chip stocks beat it by 13%, 13%, which is sizable. All right. Now, and on top of it, it's got a lower beta. It's less risky, more stable in terms of its balance sheets and its financial risk. So, yeah, this is, I mean, if you're just looking for steady Eddie. Oh, and I did look up the dividend yields. The dividend yields are a 0.5% higher than the S&P 500. It's not much different than if you were to just invest in the S&P 500 index, but if you want to have the creme de la creme, the best, and eke out some sizable gains, have a little bit less risk, and have a higher dividend yield, yes, the blue chip stocks, this Brillix or the Dow Jones Industrial Average, would be something you might want to consider. So, one, their honesty. Two, this historical performance. Three, the dividend yield. Four, the less risk. Historically, and they emphasized, they wrote it very clearly, me being an author, I really did appreciate how clearly and well thought out their statements were. They also said, like, you're not going to get rich quick. It's not exciting, but this is your steady Eddie type of approach. And based on historical performance, this is a good and a time-tested investment strategy. And it's true, time-tested. But they said, we don't know about the future. So, and that's all anyone can say, because, yeah, we don't know. Tomorrow, all of a sudden, Brillix could tank and the S&P 500 could go up, and this video would be the most wrong video ever. But, based on what we can possibly know, the Christiansens are 100% correct. All right, so, and I like how you get in with drips or direct purchases through the corporations themselves to save on brokerage fees. So one, they're honest. Do I think it's a good investment strategy? Yeah, but remember, it's not so much is it a good investment strategy. Historically, it's proven to be true. We can look this up. Say, is it a good investment strategy? They claim to do X. It has done X. We don't know what's going to happen in the future. So this, according to every measure we can use, is a good investment strategy. But it's really more, is this the investment strategy for you? And because I don't want to make it sound like, yes, everybody should invest in the Nifty 50 or this Brillix fund or the Christiansens. It really depends on the individual. For example, I would argue, Nick, the accountant, I don't think you got no wife or kids. Dude, what's your debt? You have a house at 3%. You're probably doing pretty well. You could probably afford a little more risk. I mean, certainly there's nothing wrong with investing in this. This is just going to add icing to the cake. But if you're probably going to have a little bit of extra money, you know what? Go throw a couple bucks towards Elon Musk over at Tesla. Under the full understanding you might lose it all. Maybe invest overseas. Maybe invest in Alibaba. This would be gambling money. But Nick is an accountant. He's CPA. His personality is probably a little bit more reserved and risk averse. So this would be a perfect thing after Nick gets all of his ducks in order. That maybe you could go ahead and invest in this. If you're younger and you want more aggressive growth, this is not going to deliver it. But it's not. It's not intended to, be like the dot-com mania back in the 90s. So to answer Nick's question for you, yeah, no, this is, again, there's no guarantee. I can't guarantee you jack shit about what's going to happen. But this would certainly be a wise investment with no guarantees. I mean, I know there's plenty of other investments out there that you could lose a lot of money on or much risky. But if you want, what would be traditionally a conservative investment, that has proven to, kind of eke out the S&P 500. Yeah, this is absolutely, I like it very much. If I ever get around to the point that I have that much money, I pay off my house and I have my property over in Thailand, and I absolutely have nothing left to do with my money, like I pay kids way through college and shit like that. Then maybe I would do this. But even by that time, I'm thinking like, no, if I got everything taken care of and I got multiple properties, I probably would be gambling my money away on... Well, I did double my money today in blackjack. I did do that. Oh, captain, it's... you know what the secret is? Luck. Good cards. That's how the captain wins the cards. You get good cards. That's my strategy. So, anyway, hope that helped out. Hope that kind of gave everybody else a little bit of an idea, in case you're looking for an investment idea. I can't... Again, no guarantees. I didn't guarantee jack shit. The only thing I guarantee is you're going to lose all your fucking money. There, you can't sue me. Anyway, best of luck to all of you. Toodles.